While you guys are typing in the questions, I did have one come in. Let's see. Could you please explain market movement after a gap high or low in training? I mean, what to look for when the market gaps up like the S&P today or vice versa, and how to trade when the market opens in the prior day extreme. Just trying to learn the basic stage. Yeah, so the S&P in the index markets as a whole is a great example of just a big gap to the upside. And generally speaking, when you have that type of gapping, there are two different types of things. First of all, there are several different types of gaps. So this is yesterday's range, right? So let's say that yesterday's close, just for sake of ease, is right there. So we have an inside gap up and an outside gap up, right? And then we have an inside gap down and an outside gap down. There are only 4 types of gaps. That's it. Now, there are several different ways to approach this. Generally speaking, when you have an inside gap up, the probability for a gap fill is a lot higher. You're talking 60% probability or more, depending on how close it is. I mean, if it's only like it opened 1 tick away, it's like a 95% chance it's going to fill the gap. So it only has to move 1 tick. You know, so use a little bit of common sense here. But if we have an inside gap up, it's a very good probability that it's going to fill that gap. Same with a downside gap or an inside gap down. An outside gap usually means that there is some strength underlying in the markets. All of that movement took place in the overnight. Maybe there was news, maybe there was some catalyst. In this case, for today, the catalyst is China. There was some news out of China that caused the markets to go a little bit bullish. So we opened with an outside gap up. So today's scenario is here. Now, from there, we can break it down even further. So again, we kind of umbrella our way out. Initially, we have, right, you've got the gap. And within that, there are 4 different types of gaps. Right? And within those gaps, then you can start breaking it down further. How does the day start? How does it, you know, what's the first candle of the day, etc. So usually with an outside gap, the market is hunting for some form of structure. And it usually goes a little bit range bound. Like take the Friday gap up, right? Friday was an outside gap up as well. All they ended up doing is coming back to previous day structure, finding support, and off to the races. Now, what was a big clue to that? The first candle of the day. First candle of the day was heavy bearish. It followed it up with bar 2, bearish, bar 3, doji. Not that great. Would prefer a bear bar. But it did show continuation. So when it starts bouncing up, buyers are buying into that dip, right? Understandably so, because the anticipation is that with an outside gap up, there's a reason it's up that far. It's probably hunting for some form of support. In this case, we had previous structural support in the wedge. And, well, it broke through that, found the previous high of day, rotated all the way back up. So generally, when you have an outside gap, the market's hunting for some form of structure. In the event of today, we opened up. It's the first day of the month. It's the first day of the new quarter. And it's the first day of the week, a Monday. And it's a holiday, kind of, sort of, with April Fools. On top of that, we opened up on top of structure. So now the question becomes, is this a structure they were looking for? I don't know. You know, they started off the day with a mediocre bull bar into a mediocre bear bar, just bigger, into a doji bull bar, into a doji bear bar, into a garbage bull bar, into a doji bear bar. The assumption now is, okay, we're in a range. I have no reason to believe anything this thing does anymore. So when it goes spiking all the way up to the highs in that 10 o'clock news, traders are going to fade it. They don't have a reason to believe it. What reason have they been given? 4 dojis back to back? All right, that's not enough. So we're hunting for that support or resistance, but we haven't necessarily found it yet. And you'd know if we found it, because this thing would be going nuts and we'd be going with a nice trend like we had previously, right? After it found that support, it went really well. Well, arguably over lunchtime, it was pretty garbage. But, I mean, you'll know when they've found that support or resistance. I don't think we found it yet. They've tried, but we're super range bound. So, I mean, with this type of movement, probability would dictate that there's an 80% likelihood, or potentially even up to a 90% likelihood, that we've already seen a lower high of day. We already know that, right? By the time bar 18 closes, we have seen the high of day or low of day 90% of the time. Either this is going to be the low of day, or this is going to be the high of day. At the time, it would have been here. Now, the fact that we've made a new high of day leads me to believe that this is probably going to be the low of day for the rest of the day. Does that mean that's going to be the case? No, there's still that 10%, right? There's no such thing as a 100% bet when it comes to the markets. There's always an offshot. As an example, Based on probabilities, there are, on a 5-minute chart, on an RTH chart, 81 candles in a day. Here you can see 80, there's 81. There are 81 candles in a day. You'd think, man, there's a 100% chance that we've seen the high of day or low of day. False. There's a 99.9% chance that you've seen the high of day or low of day. There's that 0.01 that can still happen, and that's because the markets will do whatever the hell they want to do whenever they want to do it. But with a reasonable doubt, we've probably seen the low of day put in, or beyond a reasonable doubt, which means that buyers on this pullback are going to be buying the pullback with stops below the low. And they have every reason to believe that, because 90% of the time it's going to be right. Now, if they bought up here, that doesn't mean that the market's going to close way up here. It just means that it's going to close above this. So they could still take a loss. But the closer they can buy into it, right? Put yourself in the perspective of probabilities. If I know that I have a 90% probability of being correct and I can buy it, let's say a low of day, like a double bottom or one tick off the low of day, you can't get much better than that, you know? So if it does come down to lows, you're probably going to see a huge amount of support coming in down here, because everybody knows that they have a very high probability of being correct. Or if they want to play it safe, offset the lows a little bit. So, I mean, today is one of those examples where we really haven't been given the proof of anything yet. Market hasn't given us anything to believe. I believe the upside, but I believe that I would want to get a deep pullback. Let's see, can we find any other outside gaps? There's an outside gap. Outside gap up, right? Yesterday's close was right here. Let me go back a little bit. Yesterday's high was right there. The close was right here. Low was right here. We have an outside gap up with a very, very strong start. 3 candles back to back to back, right? Just boom, 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 all the way up. When you have that amount of strength, buyers are going to assume that there's going to be a second leg up, and they're going to buy for any reason they can get their hands on. They're going to buy the close of bar 3, buy the close of bar 4, buy below bar 4, buy bar 5, buy everything, because the assumption is that we're going to go up to another leg higher. Now, we can utilize that assumption to our advantage, because what happened, right? We know that buyers are buying very, very aggressively given the way that this is moving. But it ends up hitting the high and pulling all the way back down. Now, it never trapped the low, but with this pullback, this isn't doing what the buyers wanted it to do. That move to the upside they were expecting was a 2-legged move, right? They wanted to see something like this, right? Back up into potential resistance. That didn't happen. So the fact that that didn't happen means that when it starts pulling back, nothing has changed. The game plan is still the same, buy the pullback, right? But now they're going to be buying with the assumption that, okay, well, if it goes back up to the highs now, I've had to sit through this pullback. I was wrong on the assumptive second leg up being a measured move back up into support or resistance. Now I'm thinking what? I'm thinking that if it gets back up to the high of day, I'm going to get the hell out of the position. So what do you think is going to happen when it reaches the high of day? It's probably going to pull back on itself. In this case, there were so many buyers that got out of the way that reversed the day. And that ended up being, guess what? Bar 18. That was the high of day. You can't write that. So this is one of those probabilities where understanding the context behind the move and realizing that, wait a minute, a lot of buyers on this dip are probably going to be pretty pissy, right? A lot of people will have stops underneath that low. Smart buyers will accumulate those lows and look for the retest of the highs to exit. But do you think it's a coincidence that bar 18, the one that sets that 90% probability standard, do you think it's a coincidence that that's the candle that hit the high of day? I don't think so. Maybe. I don't think so. I think it's super coincidental if it is. I mean, it's time to go out to the gas station, buy a lotto ticket if that's a coincidence. So the fact that that was the coincidence, there's going to be a lot of traders who don't understand the context behind the scenes and are buying on this dip. Guess where their stop is going to be? Below the lows. Well, it doesn't make any sense anymore. All the buyers are out of the way. They're gone, or most of them, right? They have had no reason to stay in the trade anymore because of that pullback. So when that pullback came around and we reached the high of day, guess what? They're liquidating. They're not liquidating, you know, all the way at the highs. Remember, they're building into positions. They have to phase in, phase out of a position. They're exiting with a flood of buyers that bought above 16. They're exiting above 17. They're exiting at 18. They're exiting below 18. They're starting to liquidate more aggressively, right? Get out. It pops back up, traps a previous candle's high, get out of more, right? That's where they're starting to liquidate. Buyers come in above par 26. If they haven't liquidated everything, what better place? Trap the suckers in the move. Get here, take them. I don't want them. You can take the contracts, buy them all you want. Why do you think bar 26 failed? Buyers are dumping, right? Take it. I don't want it. Nope, take it. You can have it. And then it rotates all the way back down. All the buyers who thought they were safe buying bar 26 with a stop below the lows, guess what? Tapped out. Now, caveat, you could play that to your advantage, right? You notice how well this level acted as support or resistance? That's because the buyers who still got stuck here, that doesn't mean they're going to give up. They're going to buy more below the low thinking, hey, I'm smart, right? I'm going to accumulate the lows just like they always do to me. I'm going to get them this time. No, because they don't have a reason to accumulate the low. They're already out. And what happens, right? If they bought there and bought a new low, break even is right there. Notice where it fell short of? That's because the sellers who are already out, they're accumulating short positions like we already talked about. So as it starts popping up, they're selling into them because they want to prevent that from happening. And if you can prevent them, if you can pony up enough muscle to push that off, guess where the stops are going to be? Below the low. And if you can hit that, you're probably going to get a nice follow-through move. Now remember, this is an outside gap up. So what's the follow-through move looking to do? Retest structure, previous high of day, right? Go back to yesterday. Where's the previous high of day? To the tick. All they were looking to do, remember, they've been accumulating shorts probably from inside there, on this bounce, that bounce, inside there. We finally got the trap to the downside. As it starts failing lower, start exiting those positions. Comes back down again, start exiting those positions. Dips below it, start exiting a little bit more aggressively. And now they can get out. So what do you think is going to happen now that we've reached that previous structural level of importance? We're probably going to bounce back. It's just this game of back and forth. But understanding the context is the important part.